another negative week, down nearly 3% on the S&P 500. There's lots to focus on, both on the macro level. We saw a really good GDP number and some earnings reports that came out this week. Both of them moved the market. So let's start on the macro side. We saw a GDP number that was way over 4%, somewhat surprising.
It really was. And 4.9% is the annualized growth of GDP, really driven by three things: consumer spending, a big swing in inventories, and government spending. So when I look at the consumer spending, a lot of that was driven by services. Maybe that whole summer splurge on Taylor Swift concerts and Beyonce and travel, that's not likely going to persist as we go into the fourth quarter. The inventory swings, those are always a wild card. Is it the case that businesses really were underproducing and needed to kind of build up their inventories, and now have they overestimated what demand is going to be like going forward? And then that government spending one, national defense and infrastructure. Well, on our investment committee, when we're looking at that infrastructure spending, believe it or not, that is not likely going to peak until we get to 2026. So government spending is likely to make continued positive contributions to growth going forward, but consumers might become a drag.
Yeah, so let's take that apart real quickly. And the reason why we spend so much time on the GDP number is because, of course, we know that positive GDP keeps us away from a recession. The 4.9% third quarter GDP will likely be revised downward. We saw that about 1.5% was this inventory growth in the third quarter, which could be used in the fourth quarter as we start to slow down. But I do agree that that's something that we have to pay attention to. It is going to go into the conversation that the Fed has next week. Very likely that they stand pat because the PCE number came in. The inflation indicator that they like to use was better than expected.
It was, yeah. The personal consumption expenditure for inflation wasn't all that bad. It was a slight uptick, but everybody was kind of expecting that because of the services component. A key thing is shelter costs are continuing to come down. We're not seeing an acceleration in service prices. Now, keep in mind that lower inflation does not require lower prices. So a lot of people kind of think, hey, cost of living is still high. Well, yes, it's still high, and it's going to go higher. It's just a question of, is it getting closer to that Fed's target of 2%? We're getting closer to it. But from our investment committee's perspective, 2% is still maybe a 2025 story, not a 2023 or 2024.
And that is worth repeating. So, folks, when we talk about inflation, the rate of change, that means if they're targeting 2%, that means they only want prices to go up 2% and not the 9% that we saw last year. Really, as you said, that doesn't mean prices are going down. They're just not going up as fast. And so the inflation number that the Fed is looking at is getting closer to their target. Expect the Fed to stand pat next week. Now let's switch gears to what is happening with earnings reports as we go through major earnings report news this week.
Yeah, we're actually about halfway through the earnings season, at least as measured by the S&P 500. And what we've been seeing is that a lot of businesses have been beating, but you've also seen some big misses as well. So this past week, we really saw a company like Microsoft or a company like Amazon seeming to fire on all cylinders, exceeding expectations. But then you have companies like Meta, also known as Facebook, and then Google, also known as Alphabet, those actually missing expectations. They had growth in their earnings. It's just, it didn't meet those lofty expectations that were set for them.
And so they talk about the Magnificent Seven, the seven big stocks that really have been driving. And so that is the reason why we do highlight that. But folks, there are another 493 companies that need to report as well. And we watch those as well. Some really missed the boat in a large way.
They did. And one of the ones that I was really paying attention to is like energy. That's an area that we've really liked because we know that with the conflict in the Middle East, that's supported those oil prices. These are also, a lot of them are cash cows. But then a company like Exxon or Chevron, they reported, and really they're actually seeing some squeezing as far as their profit margins when it comes from refineries. Now, they've announced a few deals to really be big players in the Permian Basin. So we'll have to maybe look at this one more for the long term and not necessarily just based upon how they did in the third quarter.
And as you know, folks, we often talk about what you own and why you own it. And as folks come in and we go through their portfolio review, they understand that they may be underweighted or overweighted in places that they shouldn't be. That is the wealth metric that we talk about.